capital gains, selling, inside an after-tax account, you have capital gains, different ways to mitigate capital gains. There's some flexibility there. If you're, again, retired before you're taking Social Security, you theoretically can have a lower AGI, so your capital gains rate can be lower potentially. So that's an advantage. There are ways to mitigate capital gains. There's qualified opportunity zone funds. There's obviously charitable giving, donor advised funds, and things like that. So when we know what the cash flow needs are going to be, we can do some preparation ahead of time to try to minimize capital gains taxes on that piece. So selling certainly is an option. Now back to like, when do we counsel clients to sell versus not? Some of it, again, comes down to client preference. Like, clients will have a certain target price in their head that they're okay selling at. And we as advisors try to have that conversation, because if you can put it out there into the world, or have the client put it out there into the world, it becomes a little more firm, because we've all been through the crypto experience of riding something up and then riding it back. Yeah. So we do try to, again, have those conversations. And then back to the barbell strategy, depending on what our cash flow bucket or our cash bucket looks like. If we've depleted some of the cash bucket and then the market comes back up, then we may look to sell from those appreciated assets now to refill the cash side. So those kind of, again, dialogues, those kind of discussions happen on a regular basis throughout the year and over the years as their net worth ebbs and flows, depending on what market conditions are. So that's the selling side of things.